Hello everyone, welcome to this series of interviews giving you an insider's look at ESG. My name is Aniket and I'm a co-founder of Zersent. Joining me today is Leslie Nicholson, who was the head of Indices and ESG Data Products at Toronto Stock Exchange. We discussed some of the pressing topics in ESG investing, including the need for and the trade-offs that come with quantitative ESG data, the possibility of mandated climate change disclosure, and the future of ESG. I hope you enjoy our conversation as much as I did. Alright, let's get into it. Thank you for joining us, Leslie.
You're welcome. I'm happy to be here.
Perfect. Would you be able to describe your role at TMX Group for our listeners and what your role looks like in terms of ESG and how that is working out?
Sure, Aniket. So I had the ESG and the indexing business at TMX Group. We operate the Toronto Stock Exchange, the Toronto Venture Exchange, the Montreal Stock Exchange, and the clearing agencies for these entities. So that's a lot of entities under one umbrella. Indexing focuses on the equities, listing businesses, and derivatives as well. For the past couple of years, the index products have focused completely on ESG indices and making sure that we're meeting investor needs in those areas. And so I work in the data and analytics division. Our mission is to provide investors with the information they need to invest in TSX, Venture, and Montreal Exchange derivative products. So this runs the gamut of information, analytics, and any data products that our investors need to trade any of our products. So as the head of the index business, I focus on offering indices and benchmarks that are needed in the Canadian market. And like I said, that has meant in the past couple of years focusing on ESG almost exclusively, which has been really interesting because as investors have focused on it more, I have gotten I've ramped up on my knowledge of it, and I've also taken part in our corporate-wide ESG efforts, our own ESG efforts as a publicly listed entity ourselves. That's a mouthful. So we have launched in the past couple of years a multitude of different ESG indices whose basis are our two main benchmarks. And our two main benchmarks are the S&P TSX Composite. S&P is our index calculator and partner in the index business. The Composite is our broad-based index, and the S&P TSX 60 index is our large cap index, which holds 60 of the largest cap Canadian names. We've also launched thematic ESG indices, which are another way that investors can gain exposure to sustainability. Thematic indices, as most of you probably know, focus on one specific concept or one subsector, clean energy being a common one that's focused on right now, clean energy infrastructure, battery metals, for example, renewable energy. These are all areas where we have thematic indices and where we see the demand for investing ramping up as well. And lastly, my work with ESG indexing at TMX, because I'm so deeply involved in understanding ESG disclosures that public companies are making and learning best practices in this area, I also have joined our corporate team that develops and determines TMX's own ESG strategic planning and focuses on our own reporting. We strive to be a leader in this area, of course, as you can imagine.
Fantastic. That's very interesting. In particular, putting together thematic groups and then working and building reports internally as well seems to be very interesting as well. In terms of, for example, putting these reports together, or looking at putting thematic indices and looking at various companies and how they're performing ESG wise, investors currently might be having a harder time extracting data from these reports. It's not completely unusual to see reports that are 50 to 100 pages long, going over various ESG things. But really, the quantitative data that really matters to investors only makes up a small portion of that. What's the best strategy, or how do you cut through the noise and collect the meaningful data you need?
So this is an important question for investors and companies alike, Aniket. There are a few areas within ESG that are quantitative. Many of them are qualitative. In some cases, companies don't know what to report in terms of quantitative information. They're being asked by investors to report, and to report as much as possible and to report it publicly, which which is all valuable. But like you're saying, without more definition in what exactly they should be reporting, how are they to know? And I do applaud the companies that are putting out more information, but you're right, 50 to 100 pages is a lot to digest. Even with today's strong AI, artificial intelligence capabilities, it's difficult for investors to ingest those large reports. Um, so in my interpretation, there's really a lack of overarching guidelines helping companies to determine what to put in a report. With the exception of governance, governance measures are required as a listing. For all listed companies in Canada, they have to report their governance figures and statistics and facts. But there's still more that they should be reporting, and they don't have the right frameworks to know what to report, given that there are so many frameworks. But I can get into that a little bit later. But um, in so many cases, we're seeing that ESG reports are lacking quantitative information, but that companies want more guidance. And for social, for example, it's employee engagement statistics, it's diversity of the workforce, it's pay parity, employee turnover. For environmental, that's where we see there are the best frameworks, because I think, as most people are familiar with, climate and environmental impact tends to be the most focus from investors, institutional and retail. Across the board, investors are very focused on companies' environmental impact and getting to net zero, et cetera. So we've seen the most beneficial work in frameworks and guidance in environmental reporting. And the one that we endorse as an exchange, and that we see the most investors globally, not just in Canada, embracing, is TCFD, the the climate task force for climate disclosure. I did want to mention that for governance, the quantitative measures are things like board makeup, professional backgrounds of the board members, independent board members, and the quantitative information is so valuable because it's easily comparable from company to company. So there'll always be certain measures that do not fit easily into a number, and that's where standardization comes into play. Where the more we can find ways to standardize the information that's being asked for, the better we can compare it across company to company. For example, qualitative information that's scored can have more of a bias to the various ways that it can be analyzed. This is, I think the more we see frameworks like TCFD allowing investors to have a way to frame the qualitative information and to give more quantitative information, we will see the biases in scoring, unfortunately. But that's where it tends to fall on investors to choose what methodology they believe in. And just like different investors will come to us and say what kind of ESG indexing they'd like to practice and can we help them with that, I also have found that before they get to that point, they have chosen their own ESG methodology that they believe in. And different scoring companies, sometimes they'll choose 3 or 4 of them that they believe in their methodologies. And this is an investor choice. It's a way for investors to put their own stamp on their investing, so that they can meet their own client needs and put investments into the entities that have that are ranked, in the scoring that they believe in. And that's time consuming for investors, but it's also a hugely important part of the process. Once they find their trusted ESG providers, they can then move forward and use those same ESG providers that they believe in. The last framework that is heavily used in North America is the Sustainable Accounting Standards Board, SASB for short. They have industry-specific criteria for sustainability, and while not all of them are quantitative, the qualitative pieces are quite straightforward and can be turned into a quantitative number. They can be turned into numbers and figures to be compared across companies, but they also focus a lot on materiality. And I think we'll probably talk about materiality in a few minutes.
Another challenge that might exist is in order for a company to really create value from the ESG strategy, they really have to embrace the environmental, social, and governance components. So an organization may have one but be missing the other two, and then the full value creation effect it just doesn't exist there. How do you make sure that ESG indices holistically include all three components? Can you tell me more about the strategic planning process for that?
Um, yeah, so to answer your question, Anakit, value creation is maximized when a company manages its environmental sustainability, social impact, and governance to the fullest extent possible. So, in different sectors, we see this manifest itself in different ways. And we see companies doing materiality assessments of their ESG risks and opportunities, which is hugely important. But, like you're saying, not only do they need to report, do they need to do the analysis, and then they need to report on the analysis, but we also need to capture that in our indexing and in our ESG scoring and scores that go into those indices. So there are two primary types of ESG indexing. Leaving thematics aside for a moment, the two types of ESG indexing are to improve the sustainability of a portfolio without taking on more risk, and where the goal is to attain returns in line with the benchmark. And the second type is exclusion based, choosing a portfolio based on higher ESG scores and higher sustainability without focusing on keeping the beta and the risk profile similar to the underlying benchmark. And so in this latter case, you can see returns that differ, and the investors are choosing ways in which they feel their returns will be higher than the benchmark, of course. But the risk profile is also different, and they are completely excluding a number of companies. Sometimes it's 50% of the index, and sometimes it's as high as 75% of the index in favor of maximizing the sustainability. And ESG scores are required for both types of sustainability investing and used in conjunction with the benchmarks or with other measures. Sometimes multiple ESG scoring are used. And this brings us back to the importance of accurate and unbiased ESG scores. And where it's really important in E and S and G together is the materiality for each sector. Materiality differs, and the level of materiality, the risks and opportunities in the different measures within the E and the S and the G differ within each sector. And so the real challenge is keeping up with our changing world and the changing risks and opportunities of each sector. And so what we see is scoring agencies. The one that's behind our indices is S&P Global Sustainability One. So we see those scores keeping materiality close at hand, and reviewing the questionnaire and reviewing the criteria that go into those scores, changing every year for every sector. And it's a lengthy process. It takes many analysts, but it's worthwhile because ultimately you get the best assessment for each sector every year. And you see companies reporting new information each year as our world changes, and they have to keep up with their risks and their opportunities to make sure they're all reflected in those E and S and G measurements.
Fantastic. You mentioned that the requirement for many analysts to take on the work and analyze this. What are the trends you've been seeing for new analysts or analysts currently at TMX in terms of knowledge about ESG and the ability to take on these challenges?
So the staff that does the scoring is with S&P, and they're in a sustainability entire division of the company that's focused on sustainability. So I would say that they are absolutely far and away the experts, from my point of view, on assessing materiality and understanding what's coming, and where companies are having to react and change to the outside world and to the stressors and the opportunities that they face. With every changing month and quarter, especially in a situation like now where the pandemic has thrown everything on its head a year and a half ago. But the analysts and the teams of people are essentially the industry experts who live and breathe ESG and sustainability and materiality assessments, and truly follow on a daily basis, the anything that's changing, whether it's regulations that are changing, whether it's reporting requirements that are changing, whether it's what investors need that's changing. For example, a year ago, the European Union passed a requirement for funds to do deeper and more transparent ESG reporting. That's been a big change for Europe. It's SFDR, and and then more recently we had COP26 in Glasgow, which there was a lot of information coming out of that companies are also having to incorporate and think about what they will be reporting on differently and what risks and opportunities they'll face as a result of the government leaders that have made some decisions in those meetings.
Definitely. Speaking of government, definitely the elephant in the room. Recently, CSA has made recommendations about mandating climate change disclosure, and certainly there's been a lot of disclosure about mandating and requiring companies to disclose ESG data. How have you noticed, or what have you noticed? How is ESG changing, and what do you believe is the future of ESG, and potentially will it be mandated to disclose?
So I mean the short answer is um, I think mandated is probably a strong word, but I do believe in Canadian listed issuers and their dedication to reporting and reporting well, regardless of the many different entities that are calling for it. Um, so I think standardized reporting is being called for by investors and by the issuers themselves, not only to get the right information out there, but also to cut down on the amount of noise and the amount of unnormalized reported facts and figures that are frankly taking up time for the people who are reporting on them and adding noise to the reports that investors are trying to read. So I think everyone's in favor of streamlining reporting from a company, from the company ESG reporting perspective. Um, and CSA is the right entity to do it. And I think they will they'll take very seriously their role in making sure it's done right, and that it's done once, so that it can be going forward be the right way for reporting to occur and for companies to determine what they should really be focusing on. Which is not to say that the CSA will decide what is material, uh, but that there will be ways for companies to figure out where they can cut down on some of the noise that they feel might have been expected of them in the past, but that isn't going to be needed going forward. So with normalized ESG information and data, issuers can focus on putting out what really counts and putting their teams on the information that investors can use in a more favorable way across listed issuers. And I mean, if you think about the comparable nature of financial health measures and the straightforwardness in making comparisons between companies, I think everybody will breathe a sigh of relief when we get closer to that with ESG reporting. But I do think about the amount of progress we've made in the past 5 or 10 years with certain frameworks emerging as the most trusted. And I'm very optimistic about the future of ESG reporting and scoring and how positively that will impact indexing and passive and also active investment portfolios alike. The public disclosure has been one area that we've seen a lot of progress in, which has been just a really positive impact on investing, where rather than reporting to entities like rating agencies with information that they want, companies are realizing they need to put it out there in the public domain so that every investor has access to the same information. So that's been a very positive development in the past 5 years, and it's become the norm. So I think that especially in Canada, we see large issuers doing the right thing before it's mandated of them. And I do think we're a leader in that globally, especially our largest issuers who have been reporting for longer than larger issuers in other jurisdictions. But as far as the CSA is concerned, they've put out a draft of their climate disclosure guidance piece, which is, probably the most focused on of the other than social and governance right now. I think governance probably came first, environmental is kind of coming second, and social will be closely followed. But the CSA guidelines embrace the TCFD principles, and many larger companies in Canada have been reporting under TCFD for a number of years already, and they might have their own separate report, even an ESG report plus a TCFD report. So they'll be well poised to meet the CSA guidelines, which is great. But I would point out that nearly 3/4 of the 225 roughly S&P TSX composite companies put out ESG reporting in some form already. So we have a history in Canada of strong ESG reporting, and the large cap issuers being the leaders. We've really seen that uptick in the composite, the mid cap companies as well. And hopefully we can see that come in for small cap issuers and our venture exchange as well over time. And we have been putting forth great effort and launching tools and guides and help for those smaller issuers who don't know where to start. We've helped them with frameworks and templates and consulting services as well to help them to report their ESG information as well. Because I think now that we've seen larger and mid caps doing so well at it, we want to make sure that smaller companies, especially venture companies, have a way to meet these investor needs, but within the scale of those organizations, being much smaller organizations. But I feel very positive about the future of ESG reporting and the guidelines and frameworks. We're moving very much in the right direction. So I feel very positive about the next few years. I think change will come more quickly in the next few years than we've seen it in the past number of years as well.
That's very encouraging to hear. My last question to you is for any investors out there who may be listening to this podcast, what words of advice would you have for them going forward who may want to become future sustainable index owners or things like that?
Well, I would encourage them to really understand the differences between the types of sustainable investing. I described sort of a few, the thematic investing, and then exclusion investing, and tilt investing is really the term that's used for tilting a benchmark, investing in the same constituents as a benchmark, but tilting it to have a higher sustainability profile. I would encourage investors to really do the research to figure out where they sit in terms of the sustainability that they would like to see in their portfolios. And in many cases, this is understanding what their clients are looking for as well. But just understanding the amount of change to a portfolio that an investor is willing to take on in order to meet those sustainability goals.
Fantastic. Well, thank you so much, Leslie. I think this was very helpful and very informative. So I really appreciate coming on the podcast and discussing what TMX has been up to.
You're welcome. It's been a pleasure. I always enjoy talking about this topic.
Likewise. Thanks a lot.